Yeah, okay, so we've got today's webinar. We've got Markus Meinzer, who's here from the Tax Justice Network. So Markus has developed a risk assessment tool for analysing vulnerabilities and illicit financial flows in Europe and other parts of the world, I think, as well. But he's going to focus on Europe today as part of the Horizon 2020 COFFES project. So that's a project with a lot of overlap with the Protex project, which Trilateral is involved in. And we're welcoming some people here from the Protex consortium on today's webinar as well, so welcome to them. So this is a kind of an online interactive portal, but it's yet to be fully functional and operational, I think, as Markus will discuss. But he's going to talk about that as part of his presentation and talk you through how I think it'll become functional, if that's right, Markus. So I'll just pass over to you, Markus, and he can guide you through his talk. So, Markus.
Thank you very much, Matthew, and thanks a lot to Trilateral Research for the floor today here, and thank you all for your interest in joining. As Matthew already indicated, I wish that the tool and the platform was more final as it is right now, but the Corona has come in the way. The firm that worked with us on this had to do some short notice Corona response work, so we still are hopeful that in a few weeks this will be live, and I can already show you a few things that are working, but this please without any citation or any further sharing of the URLs, because these are only testing previews and the data might still be flawed or erroneous in one case or the other. But I will still introduce you to concept first before going to the actual portal through a traditional slideshow, and then I hope to keep it all to 30 minutes so you have enough space to ask all the questions. So I will switch off my camera now. So as for the background of the illicit financial flows concept, let's start maybe with a quick bird's eye view of this. As you probably all know that the reduction of illicit financial flows is one of the Sustainable Development Goals the UN has agreed upon for achieving in 2030. So this is a global initiative to improve the livelihoods of many and combat crime and illicit activities more effectively and determinedly and more efficiently. And our model, our concept in this risk assessment tools departs from the notion that that it's widely established that there is a link now between financial secrecy and illicit financial flows. The higher the secrecy in any given transaction, the greater is the likelihood of it having an illicit component. And this does not only hold for illegal origin capital transactions like classic money laundering, consisting of laundering of the proceeds of arms, drugs, or human trafficking, but also it applies, or corruption, but also it applies to legal origin capital like tax evasion or tax avoidance. We have seen in the past through leaks that multinationals are equally eager to hide their affairs from public view, as are usually the other more outright criminal activities. This is a case of Apple, the phone manufacturer, that was revealed in the Paradise Papers to have demanded of Appleby, the law firm, to provide them with a list of jurisdictions for potential investment and holding location of their affairs. And one of the questions that they asked was the following. It was here in a red circle. This was the questionnaire that Apple sent to the law firm for them to provide them with what information is publicly visible when a company is registered in a jurisdiction, clearly in an intent to determine their location decisions, also by the question on the disclosure needs. For example, if financial statements are online available, if ownership details are online available, etc. So it is a given that not only individuals but also corporate groups are seeking secrecy for their affairs, and tax avoidance might be positioned as is here a spectrum of the tax positions that are part of the illicit financial flow spectrum. tax avoidance can be legal or entirely licit on the right hand of this concept chart here, or it can be outright criminal. And I understand today the audience here is more interested in this criminal part of the illicit financial flow components. Here we do not see money laundering and corruption flows. This is just the tax spectrum of the illicit financial flows. Now, the motivating question for our model is, when you consider the entirety of a jurisdiction's external economic relations, where is the highest risk for illicit financial flows to occur, and which jurisdictions are responsible for tackling the issue? Then what data sources are available, and what can we draw as conclusions from this? We conceptualize the illicit financial flow risk as a product of the level of financial secrecy and the size or the volume of cross-border flows, stocks, and transactions. We use the level to determine the level of financial secrecy. We use the secrecy scores of the financial secrecy index, and to determine the size and the volume of cross-border economic flows, we use 4 bilateral external economic data sets on trade, on FDI, foreign direct investment, on portfolio investment, and on banking assets and liabilities. These are taken from the United Nations Common Trades database, from the IMF's CDIS or CPIS data sets, or the Bank for International Settlements banking statistics. Now, this is the matrix, what we call the illicit financial flow matrix, to establish the link between the economic channel in review and the illicit financial flows. And for example, here you can see in the third column, illicit motivation tax, you can see how the manipulations of prices, the underpricing or overpricing, is leading to profit shifting. This matrix provides real cases taken from FATF or other studies, where we have established a link on how trade mispricing or other manipulations have resulted in tax abuse, in money laundering, or in corruption cases. So this is just to illustrate that what we are picking up in our data set is not invented, but these are real world cases and has real world relevance. This is another example for the tax aspect. Rather, in inward direct investment, you can see the case of an Australian extractive company that has, through treaty shopping, through locating of a subsidiary in the Netherlands, successfully avoided the payment of more than $7 million of withholding tax in Malawi, in one of the poorest countries on earth. Now, this is just the overall concept to introduce you to the formula. What we are measuring here, it's vulnerability, intensity, and exposure. I will not run through all of the formula, but it's just the 3 concepts are important to understand. The vulnerability one is probably the most important and relevant for this call today. Vulnerability is basically the volume-weighted average secrecy score in any of the 8 main channels, which indicates the secrecy level in each channel of a given jurisdiction. The intensity, in contrast, is just the channel's overall importance over GDP of a country. So if you have imports, if imports are 10% of GDP, the intensity in the import channel would be 10. And the exposure is the vulnerability multiplied with the intensity to give you a big top-level view of the entire risks distribution in your economy. Some countries are more exposed, have a larger share in cross-border trade over their GDP than others who might have a higher share of their economy being portfolio investment intense. Now, as for data availability, we are using the financial secrecy index scores. At the moment, this is still 2018 scores. What you are going to see in the model, we are going to update this with the 2020 scores and implement that. Once we launch the portal, it will be with the new data. Then it will be covering 133 countries, the secrecy levels of 133 countries. This is covering far more than 80% of the global portfolio investments. I think it's 95%, and it's also covering much more than 85% of global FDI. So it covers the largest share of the global economy. And we measure here the intensity of the the financial secrecy through 20 indicators, which can be grouped in 4 categories. One is about ownership registration, issues such as free ports are also included, whether free ports are requiring the registration of their owners, or whether real estate registries are established. This is all indicator number 4 here on the first column, other wealth ownership, or the usual transparency or registration requirements on trusts, foundations, and bank accounts and companies. So is there very intense banking secrecy or not? And then legal entity transparency is questioning to what extent is data made publicly available, the owners of companies, but also the accounts of financial statements. And it's important to understand that we are always analyzing this according to the weakest link principle. This, for example, if you look at indicator 7 on public company accounts, you might have a country that offers 3 different types of companies. But if 2 of those companies publish the financial statements in all cases online, accessible for free, but if only one of the 2 types of legal entities does not make those, that type of company does not require the publication and disclosure of the financial statements in all cases, then the indicator on public company accounts will be assessed as fully secretive, because the assumption is that anybody who seeks to hide their affairs is going to be able to find the legal entity with the least available transparency levels. So all of that data is fully sourced to original data, laws and regulations, to OECD reports, Global Forum reports, FATF reports, and paragraphs, and is academically referenced. You can find all the references in each of the database reports, and all of this is open data as long as you are a non-commercial non-commercial entity, or use it for non-profit purposes, and then you can access and download the data for free. We have data gaps in the bilateral economic data sets. Predominantly, it is in the economic data sets where we have gaps. Ways to overcome these is the usual methods is like panel data over many years, or we refresh the data regularly and automatically. But the most important thing in the tool and in our approach is the mirror data approach. So we can derive a lot of the missing data by using the mirror data of countries that do report data in a bilateral fashion. So we can increase dramatically the coverage of portfolio liabilities of outward FDI and banking claims by using the mirror data of the of all the remaining jurisdictions that report. Now, this is the first overview of the vulnerability in Europe. You see all the 8 channels in colors here on the right hand, claims and liabilities. This is banking claims. This is banking assets, so to speak, and liabilities. This is inward and outward direct investment. This is portfolio assets and liabilities. And this is trade, imports, exports, and imports. First, you can see how much this is driven reflective of data availability here, right? You can see, for example, that the United Kingdom has, and until Finland, all 8 channels are having data fields here. But here for Monaco, we only have this data here, the liabilities that are derived and the outward investment, FDI investment that are derived. So Monaco does not provide any data. Statistically speaking, San Marino it doesn't either. In Gibraltar is the only country that has some asset declaration obligations here at the bottom. Overall, if you now look, you compare Finland to UK, you can see that UK is more vulnerable overall in their external economic relationships than Finland is, when you look at a stacked chart. And if you look at the next level of countries that have 7 reporting items, Belarus until Portugal, you see that Belarus is more vulnerable overall than Portugal is. Now, this doesn't tell us yet tremendously much, but I will zoom into the data in a minute. If you look at intensity, again, this is just the importance of the channel over GDP. This does not include any secrecy. Then you see that, unsurprisingly, this is dominated by conduits and by small economies where the international cross-border volumes of flows and stocks is far higher than GDP. And if you multiply this with the secrecy score and the vulnerability, you get this exposure, which again is not much different from the intensity. It's much driven by the intensity, still dominated by the conduits. Now, when you look at the vulnerability trend over time in Europe, you can see an upward trend overall, except in banking positions. And the upward trend is especially marked in direct investment and also in the portfolio investment. And there's an outlier story, but I'm not sure that you are interested in hearing it, so I'll spare it if you ask me. Now, if we look at the intensity, we see that the importance of portfolio investment in Europe is growing over the last 10 years. We have more than 100% of portfolio of GDP now invested in portfolio assets and liabilities across Europe, and we see also a growing role of direct investment, and this is reflected again in the exposure, which is driven and determined to a large extent by intensity. You can see here that portfolio investment is the main driver of exposure. This is where a lot of the economies, a lot of GDP, absolute terms of GDP of a country is at risk of illicit financial flows. Now let's zoom in into the country level and then also go to the portal. As I mentioned before, this portal is going to be launched in the next few weeks. This is a snapshot from the website as it is now. We will update this with 2020 FSI data and with current economic bilateral data. The current economic bilateral data that we have is only up to date. It was taken, I think, more than a year ago, so there will be much more updated data. Let's zoom in just now on two countries for a start to get a first glimpse of the country's vulnerability. We see here all the 8 channels, a comparison between Austria and Ukraine. And this is average between 2008 and 2018. We can see that they are pretty much similar, both Ukraine and Austria. There's a data gap here. Ukraine does not report, it's not part of the Bank for International Settlements banking statistics, so here we do not have data. And a difference here is that the lowest vulnerability is in portfolio assets for Ukraine at 51, and the highest is in 62, and the outward FDI stock of Austria. But overall, it's a pretty much similar story. We can see here that Austria's economy is much more internationalized than Ukraine's is. We can, except for imports, Ukraine has 89% of GDP in imports, whereas Austria has 36. But the rest of it, Austria has much higher numbers, especially Austria's intensity is in the portfolio assets like 78 and 87% of GDP, and that is very, very much smaller in Ukraine. Ukraine should therefore pay attention to the FDI inward and exports and imports, which again you can see when you look at the exposure now, the multiplication, you can see that these 3 are in GDP terms the more exposed for Ukraine, whereas the portfolio asset and liabilities ones are the one for Austria, where most exposure is concentrated. But the overall numbers for exposure for Austria 20 is still higher than Ukraine's exposure 18. So Austria is overall pretty much still exposed. Now let's look at some country risk profiles. We can see that both have a pretty much similar overall vulnerability here. This is the top 10 providers of vulnerability, Austria and to Ukraine in inward FDI. So in foreign direct investment, inward stocks in Austria. So Germany invests in Austria 41 billion as of 2016. And the overall vulnerability, combining all of the, not only the top 10 that you see here, but all of the investment partners, when you weigh these stocks with the secrecy score of the partners, then you arrive at these average, these vulnerability scores for Austria and Ukraine. They are the same, but still there's important differences. You can see how Austria has an important inward direct investment stock of 3.7 billion from United Arab Emirates, which is a very high secrecy score jurisdictions, and therefore it would be interesting to see what is that inward stock and what is the implication and the risks there. And then those in yellow and those in orange are also high secrecy scores. We consider everything above 60 to be high, or 60 and above high. So we see the Netherlands, Russia, Cyprus, and then Switzerland is in the 70s even. All of these have important billion stocks of inward investment in Austria. And this is the share of the vulnerability of the overall vulnerability of Austria. It's pretty much concentrated in those 5 countries, and then a lot of others follow further down. For Ukraine, there's one interesting fact I want to pull out. It's a similar matrix. The first important point is that Netherlands is by far the largest investor in Ukraine, and it is, of course, Netherlands is a very famous corporate tax haven, and it's very widely known that a lot of tax avoidance and base erosion and profit shifting in Europe is routed through the Netherlands. So that is a risk to the Ukraine corporate income taxes and other taxes. And then we see also a very important role of Cyprus, which is a conduit. Usually there's no investor ultimately resident in Cyprus, but these are treaty shopping or conduit structures. The same with maybe British Virgin Islands. The British Virgin Islands, I would say, is the most single important item here. 1 billion of inward stock of FDI from the BVI into Ukraine should raise alarm bells. It should be followed up upon what is that investment, and is there anything questionable happening in the Ukraine. Let's change the channel now, and also a bit the countries that we focus on. And this is the let's look at Poland here. We see that Turkey is the country with the highest secrecy score in Poland's top 10 import vulnerability countries. It has a 3 billion in imports to Poland. And if we look at the United Kingdom, we see that Switzerland is the highest secrecy score in the top 10 with 76 and a $27 billion of import in 2016, which is again quite high. And Switzerland is known for all kinds of specialist tax regimes, pass-through tax regimes, that transit tax regimes that enable tax avoidance. So these surely will be of interest to audits and the tax department. Let's now maybe quickly change to the portal for the first time here to widen out a bit the analysis. Now, I hope everything is working. It is not very stable still. So this is the portal. You see the world map, and it's just a default start. This will change in the end. You can see the color coding here is a bit different from the color coding I use in my slides. You can see the secrecy score, the vulnerability 75 to 100 is red, orange is 50 to 75, yellow 25 to 50, and blue 0 to 25. So most of the world is orange here. These are just the overall vulnerabilities. Let's look at Poland now. I'm now clicking on it, and it takes a long time to load. This will all be much faster once this is final, but please bear with me for a little while. So here we go. We were just looking at imports, so I'm selecting here imports, and I need to select quickly another year for 2016 to come. So we can now see this is Poland's vulnerability. You can see here Poland and the world map with the top 10 countries. This is what I just showed you in the table beforehand. There's no big surprises here. Turkey is Poland's highest secrecy score top 10 country. But if we look into the full tree map, so these are all the importing partners of Poland, with the color code highlighting the secrecy score of the trading partners, and the size of the rectangle highlighting the volume. You can see some interesting further details here. For example, that the United Emirates has 100 22 million of imports to Poland. Then we have Antigua and Barbuda importing 146 million to Poland. That rings all kinds of alarm bells with me, at least. I would be curious to know what Antigua and Barbuda is exporting and Poland is importing from the jurisdiction. That is legitimate. Then we have another case of the Bahamas, like 270 million of imports from the Bahamas to Poland, which again is quite interesting to look into potentially. I would like to also switch now to back to the UK. Again, it takes a while to load. Okay, so we are in the UK. I would like to select imports again, and I'm loading the 2016 data. So that is again what you already saw in the previous chart, where a lot of the risk is from Switzerland in the import to the UK. But there's also other interesting jurisdictions here. If you, for example, look at here the United Arab Emirates, there's $1.4 billion of imports from the UAE to United Kingdom. And also the imports from Hong Kong, like 7.6 billion, are sizable and might be round-tripping or stepping trade from China into the UK via Hong Kong, which might be worth looking into as well. Now, let's switch back for a moment to the slides to go further with the channels. Here, I've now selected a portfolio asset channel. So, and I've chosen Luxembourg and Denmark to show you quickly about. I think the first remarkable issue for Luxembourg is the sheer size of the assets held by Luxembourg, among others, in the United States. Like it's 1 trillion, it's $900 billion held in portfolio assets by Luxembourg. Of course, this is down to the investment fund industry, but still it's a big problem because you can see here I have another analytical dimension included, because the US does not participate in reciprocal automatic information exchange on financial account data, and does not participate in the common reporting standard, the CRS. And therefore, the US is providing huge risks to not only Luxembourg, but also to a lot of Europe, because of course, a lot of the investors, in a lot of these assets that you see here from Luxembourg in the US are beneficially owned, not from Luxembourg residents, but are beneficially owned by, among others, European residents. So these would be in the risk of not receiving and not ensuring tax compliance in all cases. We have a similar risk here with Denmark, where we see $120 billion invested in the US, on which, again, there is no fully reciprocal information exchange. As long as you hold an account in the name of a shell company or a trust, the US does not share that data with, if it's owned by Danish or Luxembourgish or European residents, it does not share this data with Europe at the moment. It would be interesting also to learn much more about the actual functioning of those countries where we have a yes here, where there is an actual participation in the automatic exchange system, because we have reasons to doubt that the common reporting standard is working in all cases entirely smoothly and as it should. We know that golden visas is a big risk, and therefore I would be interested to see what does statistics say about the actual reported and exchanged data in contrast to those volumes that you can see here. How much of the common reporting standard exchange data is actually covering these amounts? And an important thing to highlight as well is that the relationship with Cayman Islands, which is a very important hedge fund center and a very important secrecy jurisdiction controlled by the UK, and where we can see that both Denmark and Luxembourg have portfolio investment in Cayman among their top 10 provisions of secrecy risks. Let me again switch to the portal now to zoom in on Luxembourg for a moment. So I hope I can find Luxembourg now. It's not easy, I have it. Okay, so we are looking at portfolio assets. And I want to look at 2016 data. So again, we have now what we already know, the Luxembourgish big investment towards in the United States and then there's a few other interesting stories. Again, a huge investment in the United Arab Emirates of 75 billion. Or we see also Panama with a 3.3 billion portfolio investment, which would be interesting to find out more what this is about and who is owning those assets beneficially. Let's switch quickly to Denmark. It's barely visible because it's yellow, Denmark here. Again, this will be made a bit more neat and tidy before we launch it. So Denmark's tree map also reveals some interesting additional insights apart from the top 10. You can see Thailand is an important destination, but also again Panama with 480 million investment from Denmark into Panama. And we have also like the Bahamas here, $155 million invested from Denmark. And if you want to look at a time series comparison, you can scroll a little bit further down. This is also part of the risk profile. You can see how in Denmark the vulnerability in banking, these two bottom yellow lines, is on average lower than the vulnerability for portfolio investment liabilities and assets. So this gives you a quick overview of each country's relative vulnerability, where is the most important secrecy in the economic relationships externally. So I will now switch back again to the slideshow. This is now the last channel, the right banking claims. Maybe a quick realization that here Ukraine does not participate yet in the common reporting standard. So this is a big risk to all those assets held abroad by the Ukraine, with Ukraine reporting over $4 billion invested in the US and Switzerland combined without information exchange, and 1.5 billion invested in Germany. We have seen stories of stolen assets from Yanukovych that were held through Ukrainian banks in a correspondent bank, in a Deutsche Bank, as a correspondent bank in Frankfurt. And with these kind of assets stolen and deposited with a Ukrainian bank would come up here as banking claims of Ukraine towards Germany. So all of these assets, without information exchange happening, should be considered high risk for the Ukrainian interest in taxing its domestic residents. We can see in Czechia how Jersey is an important and relevant jurisdiction. Again, it would be interesting to see what is the common reporting standard reporting, and what are these who are these owners who invest 180 million in Jersey. Now, as for the policy conclusions, there's a lot of potential in the policy level to derive insights to create new focus countries, for example, for the negotiation of treaties for information exchange, but also for the legislation of international tax rules when you want to establish your the taxation of your domestic residents' assets held abroad. It could be used to estimate quickly the revenue losses by the absence of information exchange, for example, but also on an operational level. This tool is very has a lot of potential in, for example, orienting capacity building priorities. Should I rather start building capacity for tackling illicit financial flows in the customs department? Is trade the big risk for me? Or should I rather focus on establishing a task force for the financial system? Because here's my biggest risks. We have begun micro data collaborations with a number of countries seeking to help target corporate tax audits through geographic risk assessments by including these secrecy vulnerability studies into the prioritization and ranking of risky companies or transactions or other reported data by taxpayers or by residents. For example, many countries or some countries do have some reporting requirements about assets held abroad or about companies controlled abroad. So by requiring these kind of data and then matching and risking those jurisdiction information by the level of secrecy in the country could help orient scarce resources in administrations. The same holds for suspicious transaction reports, which could be used, which could be, if they are systematically levied, including the jurisdiction information, they could be routinely scored according to their geographic risk by the function of the secrecy score, where of the jurisdictions that are involved in and that are part of the suspicious transaction reports, again to help prioritize the suspicious transaction reports to audit. There's a few other takeaways which I wouldn't want to push now, and I suggest we now open the floor for questions. And if you were interested to partner with us on developing any of these microdata applications further, we would be very interested to hear from you and consider the next steps and see what we can maybe collaborate on. Thank you.